Our top 12 REIT picks revealed for 2022. ApointResearch.com. Please subscribe to our channel and like the video. We all know that a lot has changed in the last 12 months, both for the better and for the worse. However, the REIT industry has performed exceptionally well in general. While several REITs were seen compelled to decrease dividends in 2020, most have started boosting them again, as I pointed out in my 2022 REIT Roadmap, exclusively published for our REIT on Alpha members. We counted over 111 companies that raised their dividends in 2021, and we predict more of the same in 2022. We'll try to be properly balanced with REITs from several subsectors. Even now, bear in mind that REITs are in the best position for dividend growth since 2010 to 2011, when the sector delivered many years of double-digit growth. This year, we have the added benefit of being able to sort for those names utilizing our REIT Tracker screen tool. Let's get started. Number 1, Simon Property Group. SPG purchased TCO about a year ago, and investors have been satisfied with the company's success thus far. So far, the stock has returned 83%. You may recall that in December 2020, I stated that we purchased another 56 SPG shares in the durable income portfolio on December 4th at $89.63 each in an article. SPG is currently trading at $146.27, with a price to funds from operations, P/FFO/ ratio of 13.1x. We expect the mall subsector to enjoy tailwinds in 2022. I said in my 2022 REIT Roadmap post we expect the mall subsector to enjoy tailwinds in 2022. Occupancy rates have already recovered roughly 200 basis points from their 500 basis point COVID-driven decrease, and we predict a 300 basis point occupancy increase by late 2022, says the report. SPG is the king of the jungle when it comes to malls, as seen by our 2022 tagline of tripling down on defense. We believe it will continue to drive shareholder value with its fortress financial sheet. Number 2, Realty Income. In 2020, Realty Income was one of just 3 net lease REITs to post positive earnings growth. Furthermore, it is on course to increase at a rate of 10% or higher in 2022. This company has a huge opportunity because it recently joined the European market, which allows it to expand quickly. To put it another way, the net lease market in the United States is worth roughly $4 trillion, whereas the far larger European market has only a few REITs engaging in it. The balance sheet and cost of capital of Realty are the key to unlocking such value. Its weighted average cost of capital, WACC, is roughly 4%, making it the only A-rated net lease REIT. As a result, it can create large investment spreads in large quantities. In 2022, we believe Realty will seek after larger portfolios in the US and Europe, as well as a few smaller net lease REITs. Number 3, Store Capital. Keep in mind that Store differs from Realty Income in that it seeks to acquire franchise credits rather than investment-grade debt. Chris Folk, the company's chairman, and CEO until recently, is known for its unit-level profitability approach. That is, in addition to corporate credit and real estate value, a crucial third payment source. This means that Store's mousetrap for finding deals is to focus on the finer points. There's no right or wrong answer when it comes to deal sourcing, as I constantly remind investors, one of the many reasons why I love owning both it and O. Its business plan was created to provide dependable internal growth by combining lease escalations, a conservative dividend payout ratio, and accretive property sales. This is essentially the secret sauce that fuels annual organic growth of roughly 5%. Furthermore, it has maintained a varied customer base while delivering large, yet safe, dividend growth. Number 4, Netstreit. Netstreit had 100% occupancy for the entire year of 2020 and the first half of 2021. Since the beginning of 2020, it has averaged $101.9 million in quarterly investment activity. Netstreit, like Realty Income, uses a credit-based underwriting process for all of its tenants. It has an experienced management team and a diversified board of directors, both of which I believe are beneficial to the value creation process. We're always on the lookout for so-called diamonds in the rough, and I think Netstreit is one of them. For the time being, however, management realizes that expansion is the key to unlocking value. Number 5. VICI Properties. The revolutionary combination between VICI and MGM Growth Properties will be completed soon. However, all of that equity will be sufficient to close both the Venetian and the MGP. To be clear, VICI will need to raise some debt to complete this M&A investment, but it currently has all of the equity it requires. The credit rating companies appear to approve of the situation even as it is. Number 6. Boston Properties. However, when contrasted to the greater REIT sector in the United States, office REITs have been on a 5-year losing streak. They trade at an 18.7x projected offer multiple, which is 27.3% lower than REITs. Aside from contributions from current developments, ancillary, parking, and other non-office revenue, for example, hotels, observatory, trade exhibitions, are catalysts. According to CoStar, office rent growth is predicted to accelerate in many major cities in 2023. Number 7. Kilroy Realty. KRC has decades of experience in capital allocation and today owns one of the most modern, lively, and long-term REIT portfolios. Its buildings are also young, averaging 11 years old versus 30 for its counterparts. Even in the midst of the pandemic, big tech continues to take up a lot of space. In KRC areas, tech leasing is up 122% year to year, while tech job posts are up more than 100% year to year. The company's life sciences portfolio is likewise expanding. It recently announced that it